Welcome to Risk Management, VaR, Stress Testing and Portfolio Risk. QF Series EP05, Financial Oasis. In quant finance, making money is the goal. Not losing it all is the prerequisite. History is littered with brilliant strategies destroyed not by bad ideas but by poor risk management. Long-term capital management in 1998. Amaranth Advisors in 2006. And countless retail traders who ran without stop losses. Risk management is what keeps you in the game long enough to be right. Value at Risk answers one question. What is the most I can expect to lose over a given period at a given confidence level? A one-day 95% VaR of $1 million means there is a 5% chance, 1 in 20 trading days, of losing more than 1 million. VaR is the universal language of market risk. Every trading desk, every bank, and every sophisticated fund monitors it daily. Historical simulation. Apply today's portfolio weights to the past 250 trading days of actual returns and find the fifth percentile. No distribution assumption needed. Parametric method. Assume returns are normally distributed and use the formula VaR equals portfolio value times z-score times volatility times square root of time. Monte Carlo. Simulate thousands of random scenarios using your chosen distribution and correlation structure. VaR tells you the threshold but not what lies beyond it. During the 2008 crisis, banks hit their 99% VaR every other day. Statistically impossible unless the model was wrong. The problem: financial returns have fat tails. The normal distribution massively underestimates the probability of extreme moves. VaR also assumes positions can be liquidated instantly. Dangerous in a crisis when liquidity disappears. Expected shortfall, also called conditional VaR or CVaR, is the average loss in the worst X% of scenarios. It answers, given that I've breached VaR, how bad does it get on average? ES is a better risk measure because it captures tail behavior. Basel III and IV now require banks to use expected shortfall at 97.5% confidence for market risk. Capital calculations. VaR uses historical data. It can't anticipate scenarios that haven't happened yet. Stress tests apply extreme hypothetical or historical crisis scenarios to current portfolios. The 2008 financial crisis. The 1987 Black Monday crash. A 1994-style bond market blowup. A COVID-style liquidity shock. The question is, would your portfolio survive? Stress testing reveals hidden concentration risks that VaR misses entirely. In normal markets, diversification works because assets have low correlation. But in a crisis, correlations spike toward 1. Everything falls together at exactly the wrong moment. This is called correlation breakdown. A properly diversified portfolio in 2007 looked like a catastrophe in 2008. Risk models must stress test correlation assumptions, not just volatility. Dynamic conditional correlation models help but are no panacea. Professional risk management runs on limits. Position limits cap the maximum size in any single name. VaR limits set the maximum daily VaR the portfolio is allowed to carry. Drawdown limits automatically reduce risk or halt trading if losses exceed a threshold from peak. Concentration limits cap exposure to any sector, country, or factor. Greeks limits for options books cap delta, gamma, and vega exposures. For derivatives portfolios, the P&L is driven by the Greeks. Delta is managed by hedging with the underlying gamma risk. How fast delta changes is managed by trading options. Vega, sensitivity to implied volume changes, is hedged by trading variance swaps or offsetting options. Theta, or time decay, is the daily bleed that options sellers collect. A well-run options desk maintains daily Greeks reports and rebalances within limits. The best quant strategies in the world are worthless if poor risk management lets a single bad period wipe out years of gains. The greatest quant investors, Simons, Griffin, Asness, are as rigorous about risk as they are about alpha. Build your models, test your edges, but always control your downside. That's the discipline that separates quants who last from those who flame out. Thanks for watching the full QF series.